purposes, terms, distributions, requirements, and other circumstances of this act. So part of what we're doing is looking at what are the initial assets that are there. Those can be influential, as we'll see later on, with regard to some of the different decisions that are made respecting types of assets that might be there on purpose. There may be concentrations there on purpose. So within a reasonable amount of time, we've got to put a plan together to say, here is how I would approach it going forward. Now, you and I both know there may be tax consequences of implementing a plan like that. So it's very important for us to consider the fact that this means that we need to put together a plan. That plan may take a while to implement, again, based on tax consequences and other market conditions that we might have, but getting up to speed, basically, quickly, is what they're trying to stress in this section here. Now, one of the things that we realize in the trust world is there is a type of accounting that doesn't exist anyplace else in the world. Most accountants don't even know about this type of accounting. It's that unusual. I've never even found an official name for it. We call it principal and income accounting or trust accounting or double cash accounting. And it's the simple fact that in the trust world, we have two sets of beneficiaries. You've got the current beneficiaries, often called income beneficiaries, and you've got the future beneficiaries, often called remainder persons. And with the concept that there is principal and there is income, basically the income beneficiaries represent the income portion, that is the earnings on current assets held by the account. And the principal, the future beneficiaries, are represented by the principal or corpus, which means physical form. It's probably easiest to think about. I die, I leave a house in trust for my family. I say I want my wife to be able to live there for the rest of her life, which means basically that she gets the use and or income from the house during that period of time, right? If you rented it out as opposed to her living in the house. And then after she passes away, it goes to the kids. So the house itself, from the beginning, from the inception of this arrangement, is the principal, and the use or income from that is the income. Trust documents all relate to what rights beneficiaries have to income and principal, whether it's automatic or discretionary. This is a critical thing for us to understand. You can imagine if you take that from a house, flip it now over into a stock instead, all of a sudden the stock that grandma died with and left into the trust is the principal in the